Something extraordinary just happened in the gold market. And if you're not paying attention, you're about to miss the biggest wealth transfer opportunity of this decade. I'm not talking about a typical bull run. I'm talking about a structural shift that happens maybe once or twice in a generation, the kind of move that creates generational wealth for those positioned correctly and devastating losses for those caught on the wrong side. Let me show you exactly what's happening right now. Gold just broke through a critical technical level that it's been testing for months. But here's what most people don't understand. This isn't just about a chart pattern. This is about a fundamental restructuring of the global monetary system that's been building for years, and it's finally reaching a tipping point. Central banks around the world are buying gold at a pace we haven't seen in over 50 years. Not just buying, accumulating aggressively. In the most recent quarter, central bank purchases jumped another 10%. But here's the part that should terrify anyone holding significant cash positions. They're not slowing down. They're accelerating. Think about that for a moment. The very institutions that print money, that control monetary policy, that have access to every economic indicator and classified intelligence report you'll never see. They're converting their reserves into physical gold at record speed. Why? Because they know something the general public hasn't figured out yet. They understand that we're not in a normal economic cycle. We're in the early stages of a currency crisis that will make 2008 look like a minor correction. Let me paint you a picture of what's really happening behind the scenes. China has been systematically accumulating gold for years, but they've been doing it quietly. They're not announcing their purchases. They're not broadcasting their strategy. They're simply buying every dip, every pullback, every moment of weakness in the gold market. And they're not alone. Russia, despite being under the most severe sanctions in modern history, continues to add to their gold reserves. India's central bank is buying. Turkey is buying. Poland is buying. Even countries you wouldn't expect are quietly building their gold positions. But here's where it gets really interesting. These aren't just random purchases. This is coordinated de-dollarization. These countries are preparing for a world where the US dollar is no longer the undisputed global reserve currency. Now I know what you're thinking. The dollar has been the reserve currency for decades. It's backed by the strongest military in the world. It's not going anywhere. And you're partially right. The dollar isn't going to disappear overnight. But its dominance, its monopoly on global trade, that's already eroding, and it's happening faster than most people realize. Look at what's happening with BRICS. Brazil, Russia, India, China, South Africa. They're creating alternative payment systems. They're settling trade in their own currencies. They're building infrastructure that bypasses the dollar entirely. And they're using gold as the foundation. This isn't theory. This isn't speculation. This is happening right now, in real time, while most investors are completely oblivious. But let's talk about what this means for gold prices. Because this is where it gets really exciting for anyone paying attention. When you have the world's largest economies systematically reducing their dollar exposure and increasing their gold holdings, you create a supply-demand imbalance that can only resolve one way: higher prices, much higher prices. And we're already seeing it play out. Gold has been hitting record highs, but here's what most analysts are missing. We're still in the early innings of this move. The real parabolic phase hasn't even started yet. Let me show you why by looking at history. In the 1970s, when Nixon closed the gold window and ended dollar convertibility, gold went from $35 an ounce to over $800 in less than a decade. That's a 2,200% gain. But here's what's different this time. In the 70s, it was primarily retail investors and some institutional money driving gold higher. Today, you have sovereign nations, central banks with unlimited buying power, accumulating physical metal. The buying pressure is exponentially larger. And unlike the 70s, we're not just dealing with inflation. We're dealing with unprecedented debt levels, geopolitical fragmentation, and a loss of confidence in fiat currencies that's spreading globally. The U.S. national debt just crossed $36 trillion. Let that sink in. $36 trillion. And it's growing by roughly $2 trillion per year. There's no mathematical way to pay this back through taxation or economic growth. The only way out is inflation, printing more money to service the debt. And what happens when you print money? The currency loses value. And what do people flee to when currencies lose value? Hard assets, specifically gold. But here's where most people make a critical mistake. They wait. They watch gold go up and think, I'll buy the next dip. But in a super cycle, the dips get bought so aggressively that by the time you're ready to enter, you've already missed a significant portion of the move. Look at what happened in 2011. Gold hit $1,900, then corrected for years. Everyone thought the bull market was over. But that wasn't the end of the cycle. That was a consolidation phase. And now we're breaking out to new highs with even stronger fundamentals than we had back then. The smart money understands this. That's why you're seeing massive inflows into gold ETFs. That's why mining stocks are starting to outperform. That's why physical premiums are expanding. The market is telling you something. Are you listening? Now, let me address something important for anyone sitting on significant retirement savings. If you have $100,000 or more in traditional retirement accounts, 401ks, IRAs, whatever, you need to understand how gold IRAs work. I put together a comprehensive guide that breaks down exactly how you can get physical gold into your retirement account without triggering tax penalties. It's in the description below. No sales pitch, just the mechanics of how it works and whether it makes sense for your situation. Worth checking out if you're concerned about currency devaluation eating away at your retirement savings. All right, back to where this market is headed. The technical picture is absolutely screaming bullish right now. We just broke through a multi-year resistance level that's been capping gold since the last major peak. And when you break through resistance that's been tested multiple times, it often leads to explosive moves higher. But the technicals are just confirming what the fundamentals are already telling us. This is a structural bull market driven by forces much larger than typical market cycles. Think about the supply side for a moment. Gold production has been essentially flat for years. The easy gold has already been mined. New discoveries are rare, production costs are rising, and it takes 7 to 10 years to bring a new mine online. So even if gold prices double from here, you're not going to see a flood of new supply hitting the market anytime soon. Meanwhile, demand is exploding, not just from central banks, but from retail investors in Asia who understand gold's role as wealth preservation. In India and China, gold isn't just an investment. It's cultural. It's how families store wealth across generations. And as these economies grow and create more middle-class wealth, gold demand from these regions will only increase. But here's the real kicker. The paper gold market is massively over-leveraged. For every ounce of physical gold that exists, there are multiple claims on that same ounce through futures contracts, ETFs, and other derivatives. This works fine in normal markets. But in a crisis, when everyone wants physical delivery at the same time, the system breaks. And we're already seeing cracks. Physical premiums are widening. Delivery delays are increasing. Some dealers are struggling to source large quantities of physical metal. These are early warning signs that the paper market is becoming disconnected from the physical market. When that disconnect becomes obvious to the broader market, you're going to see a scramble for physical gold that will drive prices to levels most people think are impossible. I'm talking about gold at $5,000, $10,000, maybe higher, not in some distant future, potentially within the next few years. Sound crazy? Let's do some simple math. The total value of all gold ever mined is roughly $15 trillion at current prices. The total value of global financial assets, stocks, bonds, real estate, everything, is somewhere north of $500 trillion. Gold represents less than 3% of global financial assets. Now, what happens if just 5% of global wealth decides to move into gold as a safe haven? You'd need to double the entire gold market cap just to accommodate that flow. And we're not talking about 5%. We're talking about a potential rush to safety as confidence in fiat currencies erodes. The math doesn't work at current prices. Gold would need to be multiples higher just to absorb a modest shift in asset allocation. And this isn't even considering what happens if we see a real currency crisis. If the dollar loses its reserve status, if we see competitive devaluations, if we get hyperinflation in major economies, gold could go to levels that seem absurd today, but will seem obvious in hindsight. History is full of examples. Weimar Germany, Zimbabwe, Venezuela, Argentina. When currencies collapse, gold becomes the only reliable store of value. And while I'm not predicting hyperinflation in the US, I am saying the risk is higher than at any point in modern history. But let's talk about the opportunity cost of not being positioned in gold right now. If you're sitting in cash, you're losing purchasing power every single day. Official inflation numbers say 3 or 4%, but anyone buying groceries, paying rent, or filling up their gas tank knows the real number is much higher. Your cash is being debased in real time. If you're in bonds, you're locked into yields that don't come close to compensating you for inflation risk. And if rates rise or credit spreads widen, you're looking at capital losses on top of the purchasing power erosion. Stocks? Sure, they can go higher. But we're at valuations that historically precede major corrections. And in a real crisis, stocks get sold to raise cash. Gold gets bought as protection. The risk-reward of being in gold right now is asymmetric. The downside is limited. Gold has 5,000 years of history as a store of value. It's not going to zero. But the upside? The upside is potentially life-changing. And here's something most people don't consider. Gold is insurance that pays you. Unlike traditional insurance where you pay premiums and hope you never need it, gold protects your wealth while potentially appreciating significantly. It's the only asset that serves as both defense and offense. Now, I want to address the skeptics, because I know there are people watching this thinking, gold doesn't pay dividends, it doesn't generate cash flow, it's just a shiny rock. And you're right, gold doesn't pay dividends, but neither does cash, and cash is guaranteed to lose value over time. Gold doesn't generate cash flow, but it also doesn't have counterparty risk. It can't be printed into oblivion. It can't be hacked. It can't be frozen by governments. In a world of increasing financial instability, those properties are becoming more valuable by the day. Think about what happened in Cyprus when the banks froze deposits. Think about what's happening in Canada, where the government can freeze bank accounts of protesters. Think about the increasing surveillance and control over digital transactions. Gold is the ultimate form of financial privacy and sovereignty. But beyond the philosophical arguments, let's look at the cold, hard data. Gold has outperformed the S&P 500 over the last 20 years when you account for real inflation. It's outperformed bonds by a massive margin. It's one of the best performing assets of the 21st century, and most investors are dramatically underweight. The average portfolio allocation to gold is less than 1%. Financial advisors typically recommend 5 to 10%. But given the current macro environment, a case could be made for 20% or more. Because we're not in a normal environment. We're in a period of monetary experimentation that has no historical precedent. Central banks have printed more money in the last 15 years than in the entire previous history of civilization. We've had negative interest rates, something that was considered impossible in economics textbooks. We've had unlimited quantitative easing. We've had governments directly funding deficits through central bank money printing. These are not normal policies. These are desperate measures. And desperate measures have consequences. The consequence we're seeing now is a loss of confidence in fiat currencies. It's subtle, it's gradual, but it's accelerating. And once confidence is lost, it's almost impossible to restore without a complete reset of the monetary system. That reset is coming. The only question is what form it takes. And in every historical reset, gold has played a central role. Look at Bretton Woods in 1944. Gold was the foundation of the new monetary system. Look at the Nixon shock in 1971. Gold was at the center of that crisis. Look at the central bank gold agreements of the late 90s and early 2000s. Gold has always been the ultimate monetary asset, even when governments try to pretend otherwise. And now we're approaching another reset. You can see it in the actions of central banks. You can see it in the rise of alternative payment systems. You can see it in the increasing frequency of currency crises in emerging markets. The current system is breaking down, and gold is reasserting itself as the foundation of the next system. The smart money is positioning now, before this becomes obvious to everyone. Because once it's obvious, the opportunity will be gone. Gold will already be at 5,000, 10,000, or higher. The easy gains will have been made. But we're still early enough that you can position yourself for this super cycle. You can still buy gold at prices that will seem incredibly cheap in hindsight. You can still get ahead of the institutional wave that's coming. Because make no mistake, institutional money is coming. Pension funds, sovereign wealth funds, family offices, they're all starting to increase their gold allocations. And when trillions of dollars of institutional capital starts chasing a relatively small market like gold, prices are going to explode higher. We're already seeing the early signs. Gold ETF inflows are accelerating. Mining stocks are breaking out of multi-year bases. Physical demand is overwhelming supply in key markets. The setup is perfect for a massive bull run. And unlike previous gold bull markets, this one has the potential to go much further because the underlying problems are much larger. We're not just dealing with inflation. We're dealing with a crisis of confidence in the entire fiat currency system. Think about what that means. Every dollar, euro, yen, pound, every fiat currency in the world is being debased simultaneously. There's no safe haven in paper money. The only real alternative is hard assets, and gold is the king of hard assets. This is why central banks are buying. This is why billionaires are accumulating. This is why smart investors are positioning now before the crowd figures it out. The supercycle is confirmed. The breakout is happening. The fundamentals are stronger than ever, and we're still in the early stages of what could be the biggest gold bull market in history. The question isn't whether gold is going higher. The question is whether you're going to be positioned when it does, because this opportunity won't last forever. Supercycles are rare. They happen maybe once or twice in a lifetime, and when they're over, people spend decades wishing they had acted when they had the chance. Don't be one of those people. Don't look back 5 years from now when gold is at $8,000 and kick yourself for not taking action today. The evidence is overwhelming. The setup is perfect. The time to act is now. This is your moment. This is your opportunity to position yourself for one of the greatest wealth transfers in modern history. The supercycle is here. The only question is whether you're going to participate or watch from the sidelines.